If I had to decide today whether Nebius is really one of those stocks that can force Wall Street into the $200 conversation, knowing what I know about the contracts, the capital needs, the momentum, and what could happen over the next few quarters, I would look at this story very differently. Today is Friday, April 17th in New York, and comment below what day and date you're watching from. And real quick, if you value this kind of breakdown, subscribe and comment John A.G. Best, so I know you want more of these deep dives. Most people think a move like this is just another hype run, a hot ticker, a flashy chart, a few AI buzzwords. But that's not really what's going on here. What's happening with Nebius looks a lot more like the market suddenly deciding this company no longer belongs in the old bucket. That's the key. This is not just a stock going up. This is a stock getting reclassified in real time. And when that happens, normal logic starts to wobble. Because in a normal setup, a name that has nearly doubled since the start of the year and ripped by roughly 2/3 in just over 2 weeks is supposed to cool down. It's supposed to run into resistance. It's supposed to hesitate, breathe, shake people out, and make everyone second-guess the move. But every now and then, the market does something different. It stops asking what a company was and starts asking what it could become if demand stays insane and management actually executes. That's the zone Nebius seems to be drifting into. Now, let me be clear. I'm not saying everybody on Wall Street suddenly agrees this thing belongs above 200. They don't. In fact, one of the most important counterpoints here is that the average target sitting out there is still clustered around the mid-160s to low 170s, depending on which set you look at, while the stock itself is already trading in that neighborhood. So if you came here thinking every analyst in Manhattan woke up and screamed 200, that's not the story. The upper end of the target range has moved. Some bulls have now pushed into that 200 neighborhood, and that shift matters because it tells you what the market is beginning to focus on. Not the old quarter, not the old valuation, not the old story. The new story is capacity. The new story is long-duration contracts. The new story is whether Nebius is becoming one of the scarce picks and shovels names in the AI build-out that can grab power, GPUs, customers, and financing fast enough to matter. That's why people are suddenly stretching the upside. Based on recently published numbers, Nebius ended last year with a little above $1.25 billion in run rate revenue, ahead of prior guidance. It also exited the year with active power well above its earlier target, more than 2 gigawatts of contracted power already secured, and a stated goal of getting past 3 gigawatts of contracted power by the end of this year. That is not small company language anymore. That is scale language. And there's a psychological piece to that too. Investors don't just re-rate off revenue alone. They re-rate when the company starts sounding less like a perpetual concept and more like an operating machine. In the fourth quarter, group revenue jumped into the low 200s and millions. Core AI infrastructure revenue rose even faster. Adjusted EBITDA in the core business moved into healthy positive territory. And the company said group operating cash flow turned positive in that quarter as well. That doesn't mean the business is suddenly risk-free. It does mean the old lazy argument that this is all smoke and no execution is getting harder to defend. There's also a reason management keeps talking about software and enterprise readiness, instead of selling this as bare metal capacity alone. The company has been highlighting newer layers like Token Factory, the Ether platform, tighter security controls, and the ability to support compliance-heavy customers. That matters because infrastructure names that can move up the stack usually get treated better than those stuck competing only on raw hardware access. And if Nebius really becomes a trusted platform for both AI-native startups and large enterprises, then the addressable market broadens beyond just frontier model demand. One more thing. Europe suddenly matters more in this story than a lot of US traders realize. Between the France expansion, the Finland project, and the broader push for regional compute capacity, Nebius is not just chasing volume. It is also positioned around digital sovereignty and lower-cost, colder climate infrastructure. In a market where location, energy economics, and regulatory comfort can shape who wins enterprise workloads, that's not window dressing, that's part of the moat. And then the market got something even more important, proof that the giant customers are real. The company has already disclosed that it delivered the first tranche of capacity to Microsoft on time, and that both contracted tranches tied to Meta were delivered on time and moved into servicing. Then Meta came back with a much larger long-term arrangement that could reach roughly the high 20s and billions over several years. Pair that with the earlier Microsoft agreement that can run into the high teens and possibly more, and you start to see why investors stop treating this as a speculative side character. This is where the re-rating begins. Because when you've got hyperscale counterparties effectively validating that you can deliver serious AI capacity, the market stops valuing you like a niche experiment and starts valuing you like a strategic bottleneck asset. A bottleneck asset, not a generic cloud company, not just another AI label. A company sitting right where the pain is most intense. Compute access, power access, deployment speed, and enterprise-grade delivery. That's why the story has legs. And there's another layer here people miss. Nebius isn't just talking about growth in abstract terms. It has been building the physical footprint to support the story. The company has talked about new sites across the United States and EMEA, a large France buildout, and a new Finland project that on its own is expected to be one of the biggest AI-focused facilities in Europe. The Finland site is planned at roughly 300 megawatts, and management has framed it as part of a much broader power land grab. Why does that matter? Because in this market, power is the product before the product becomes the product. Everybody wants to talk about models and apps and agents and who has the smartest chatbot. Fine. But underneath all of that, there's a brutal reality. If you can't secure power, if you can't secure chips, if you can't stand up capacity quickly, you become a spectator in the AI boom. Nebius is trying to become the opposite of a spectator. That's also why Nvidia's move mattered so much. When Nvidia said it would invest around $2 billion and deepen the engineering partnership, that was more than a headline pop. That was one of the most important credibility stamps this company could get. It also came with a much longer horizon ambition, tied to multiple gigawatts of Nvidia systems by the end of the decade. That kind of endorsement doesn't remove execution risk, but it absolutely changes how investors think about the ceiling. Now here's where the story gets tricky, because this is the part that separates a fun chart from a serious investment debate. None of this growth is free. That's the catch. That's the shadow hanging over the whole rally. The bullish case is easy to understand. More demand, more contracts, more power, more capacity, more recurring revenue, bigger multiple, higher stock. The hard part is how you pay for the bridge between where the company is now and the monster version of itself investors are trying to price in. And that bridge is expensive. According to the latest publicly available filings and company commentary, Nebius closed last year with about $3.5 to nearly $4 billion of cash, posted its first quarter of positive operating cash flow in the fourth quarter, and said it has multiple financing levers available, including debt, asset-backed structures, and an unused at-the-market equity program. In other words, management is openly telling you that capital strategy is part of the operating model. That is not a tiny detail. That is the detail. Because once a stock runs this hard, management has every incentive to think about funding from a position of strength. And investors know that. So the same rally that makes 200 feel possible is also the rally that makes dilution or fresh debt more tempting. That's why this setup is double-edged. If Nebius raises more money and pours it into additional capacity, the business could get even stronger. More customers can be served. More run rate revenue can be pulled forward. More market share can be locked up while others are still arguing over power contracts and delivery schedules. But if that money comes through a structure the market doesn't like, the stock can absolutely stumble, even while the business keeps improving. We just saw a version of that in plain sight. Nebius closed a huge convertible debt funding round a little over $4 billion, after first signaling a somewhat smaller raise. Management described itself as well-funded, with a plan to cover a meaningful share of growth through customer prepayments and the remainder through a mix of debt and equity. That may be smart corporate finance. It may also create volatility for shareholders who only want straight-line upside. That's the part people don't want to hear when the chart is screaming. A better business does not always mean an immediately better stock. Sometimes the market cheers the capacity build. Sometimes the market flinches at the financing. Sometimes it does both in the same month. And that's especially true in AI infrastructure, where the appetite for growth is massive, but the appetite for endless capital raises is not. If you're successful, share your success story in the comments so others can stay motivated. Now, there's another reason some people think the upside case could still be underappreciated: second-order optionality. The obvious story is Microsoft and Meta. The less obvious story is what happens if Nebius keeps winning outside those giant anchors. Management has been talking about expanding deeper into enterprise verticals like healthcare, robotics, media, retail, and financial services. It has also been pushing more of a full-stack offering instead of just raw compute rental, including software and platform layers that can support training, inference, and enterprise workflows. That matters because the market pays a different multiple for a business that looks like pure capacity landlord versus one that starts looking like a sticky AI cloud platform. And then there's ClickHouse. This part gets messy when people explain it too quickly, but the basic point is simple. Nebius still has a minority stake in ClickHouse, and ClickHouse just raised new money at a valuation around the mid-teens and billions. Nebius has also said Anthropic uses ClickHouse for observability at scale. So while that is not the same thing as saying Anthropic is a direct Nebius cloud customer, it does create a very real adjacency that investors are watching. And this is where I want to push back a little on the wilder version of the bull case. A lot of people are starting to talk as if every fast-growing AI company automatically becomes future Nebius revenue. That's too easy. That's the dangerous leap. Just because an ecosystem connection exists does not mean a giant cloud contract drops tomorrow. The market loves to jump 3 steps ahead, especially in themes this hot. So yes, Anthropic-related upside may exist around the edges, directly or indirectly. No, you should not build the entire thesis on wishful stacking of relationships. The cleaner case for Nebius is already strong enough without turning every rumor into guaranteed revenue. And remember, this space is getting crowded. Not everybody in the crowd is credible, but the crowd is real. You've got established neocloud players raising mountains of money. You've got former crypto infrastructure operators trying to rebrand into AI factories. You've even got opportunistic pivots from businesses that were never anywhere near serious GPU infrastructure a minute ago. That tells you 2 things at once. There is enormous money in this lane, and there will be plenty of bad actors chasing the same excitement. Nebius doesn't need the whole market. It just needs to stay believable while everyone else starts sounding ridiculous. That's why execution is everything now. Deliver on time, bring sites online, keep customers, convert giant contracts into visible revenue, raise capital without breaking trust. Prove the platform is more than a one-cycle wonder. That's why the next phase matters more than the last headline. If Nebius can turn those giant commitments into visible quarterly progress, the conversation changes again. If it starts showing that enterprise demand outside the giant headline accounts is filling future capacity before it even comes online, the valuation framework gets harder to cap. And if management proves it can finance growth without making shareholders feel like they are being used as an ATM every few months, the bulls get a much cleaner runway. From recent market updates, that process is already underway. But I also think people need to keep their heads on straight. This thing may absolutely go higher. It may also get hit hard on dilution fears, funding headlines, or even just a temporary digestion after a violent run. Those 2 ideas can both be true. So my view is pretty simple. The reason Wall Street is suddenly talking about 200 for Nebius is not because analysts discovered a random ticker and got excited for a week. It's because the company has started to collect the ingredients that force a re-rating. Hyperscaler validation, serious power ambition, expanding infrastructure, a stronger balance sheet than bears expected, platform breadth, and a market that is desperate for scarce AI capacity. The reason it may not get there in a straight line is equally obvious. Scale like this costs real money, and the market is not always kind when that bill comes due. That's the whole game. If Nebius keeps converting capital into capacity and capacity into recurring revenue, the upside case stays alive. If financing starts to outrun trust, the stock can wobble even while the company grows. And if the broader AI buildout keeps rewarding the few names that can actually deliver power and compute at speed, Nebius stays in the conversation. That's why the stock has people leaning forward now. Not because 200 is guaranteed, because for the first time it feels like a real debate. And as always, this is for education and perspective only, not a buy or sell order from me, so do your own homework, protect your downside, and make decisions like your future self has to live with them.